Welcome to It's the Economy. Today, ahead of the monetary policy, we look at liquidity in the banking system. Now, how does liquidity enter the banking system? These are the factors. When RBI gives a dividend to the government, or when it buys dollars or bonds from the market, it is putting in liquidity. Buying of the bonds is what you call OMO purchases. And when old government bonds mature, that also brings in liquidity. Now, liquidity can be infused by a CRR cut, but that is a one-off. So let's not consider that. Now, how does liquidity go out of the banking system? One, when you and I withdraw cash from the system, when we pay taxes, but the government doesn't immediately spend. There is a near-term deficit in the banking system till the government spends our taxes. Liquidity also goes out when Reserve Bank sells dollars and, pulls back rupees. Now, Devang Shah, one of our guests today from Axis AMC, argues that liquidity is poised to become deficit from November to March. And so the Reserve Bank should provide liquidity. But how is the question? Should it cut CRR, which is, the percentage of deposits that banks cannot lend? They have to keep as idle cash, or should they do OMO purchases? In which case, OMO, buying bonds, in which case you can infuse liquidity. Joining me in this discussion is, of course, Devang Shah, the author of a report called Acumen on Liquidity, and Ashish Gupta, the CIO of Axis Mutual Fund. Gentlemen, thank you very much for your time. For once, I'm not starting with Ashish, I'm going to start with Devang. Since you are the author of this piece, why do you think liquidity is going to become deficit?
So thanks, Latha, and good morning. So what we have tried to probably highlight in this note is that the best of the liquidity surplus is behind us. You already spoke about it, but I'll just try to cover some numbers. I'm sure we have all noticed the fall in the durable liquidity, and durable liquidity is important because durable liquidity is the total liquidity into the system, which is with the banking as well as with government put together. And we've actually seen a fall from 5 trillion 2 months back to 1.5 trillion. And it's largely because of FX outflows, some 30 to 40 billion. Government balances at the same point of time also have reduced massively, and they're now into WMA. Like on mid of September, government was holding 4 trillion of balance, and today now they are into deficit. All this has actually led into fall in banking liquidity. And our base case is that Q4 banking liquidity conditions continue to worsen due to various reasons. Is first, the currency in circulation will increase to the tune of 1 to 1.5 lakh crores. That's the general trend. If you look at the last 5 years trend, the Q4, we actually see liquidity to tighten by around 1 to 1.5 lakh crores, credit growth, and the buildup of government balance. So all this will cumulatively worsen conditions in Q4. Our actual calculation is that banking liquidity, which is durable liquidity today, is around 1.5 lakh crores, will go into deficit if we don't see any RBI action. And that is why we came up with this piece on liquidity.
Okay. Ashish, so now let me toss to you. Would you therefore say that a CRR cut is needed? Or can the Reserve Bank just, buy bonds or do, very long-term repo operations whereby they give money for a month, 2 months to the banks?
So I think my sense is RBI will be probably keener to do either open market operations or VRR. I think we have seen RBI has been reluctant to use CRR really as a monetary tool, as a liquidity tool rather, and want to use CRR as a monetary tool along with it. So just to address liquidity, I think RBI prefers to use OMOs, VRRs, but really they believe CRR and rates are the more indicators of their monetary policy stance. So I think to address liquidity, their preference will be for the former rather than the latter. I think earlier in the year, even when banking liquidity was tight, the RBI was not so keen to step in because really the aggregate liquidity, if we take into account the government cash surplus with RBI was large. So it knew that when the government spends that money, the banking liquidity will improve. Unfortunately, as Devang highlighted, over the past couple of months, there have been forex outflows, and you would have seen RBI using about $25 billion of forex reserves to stem the depreciation in the currency, right? So when they sell the dollars, they are actually taking out rupees from the system,
Yes.
and that's why the liquidity in the system has come down. So I think that can be replenished by some of the tools like OMOs and repo, as you mentioned.
Okay.
Of course, the other construct that MPC will start to consider now that growth has come off much sharper than they were expecting. And or do they need to move on the monetary side? And therefore, would a tool like CRR also come back into the equation? So I think if the disappointment on growth would not have been there, I don't think the discussion on CRR would have been on the table. But with the growth disappointment, I think at least CRR cut can be considered.
Okay. Well, Ashish, two things. RBI will not bring CRR in the MPC discussion. They have made it very clear in prior policies that MPC has control over repo. CRR is an RBI instrument. So it's quite possible that they announce it even the day before or after the meeting is over. It's quite possible, but it's not MPC's domain. The other thing I wanted to point out is during the Rajan Urjit Patel era, there was this big discussion in RBI and the banking system, and you're probably aware of it, that there is something like the psychology of bankers to give loans and to reduce deposits. As long as they're borrowing from RBI, there is a tendency on bankers not to cut deposit rates. So, this argument was made very strongly by FIMDA to Rajan, and then he infused liquidity. Do you think that will come into force again? There is a clamor, hunger for deposits, which is psychologically, making banks compete with one another. To just quell that, do you think a CRR cut will come?
So I think at least in the recent weeks that we have seen, some of the fight for deposit has reduced, at least in terms of the rates, right?
Okay.
So at least we do not see as much aggression in terms of rates being offered. We have actually even seen some of the public sector banks reduce their 3-year term deposit rates as well. This is not to say that banks are not aggressive about raising deposits, but I think banks are at least not using rates as a tool to garner more deposits. And it is also potentially because of the margin pressures, the challenges they are facing in terms of growth in loans, and particularly in the higher yield segments. So I think in that sense, the competition for deposit has come down. I'm not too sure that without a CRR cut, whether there is going to be an easing in really the deposit competition among banks. I think the challenge is that the message from the central bank is clear that banks have to grow loans lower or at least equal to the growth rate in deposits. They have to maintain or bring down their loan deposit ratio. So I think you are going to see this quest for deposit continue. But at least recently we have seen in this quest for deposits, rates are not being used as aggressively as they were a couple of months ago.
Okay. Ashish, is there even a slight chance of a rate cut? There is a strong argument that yes, the lagged inflation number is 6.2. Reserve Bank may have to bring up arithmetically the full year inflation number also from 4.5 to 4.7 or 8. But if you look 1 year down, there could be, Chinese dumping. There could be even slowdown in growth because of the noises made by Trump. So you can make an argument that 1 year down, inflation is going to be 4, and it takes about 3-4 quarters for rates to come into to take an effect. So is there even a 10% chance, 20% chance of a rate cut?
While I will not rule it out, I would kind of put it as a very low probability event because I think the other factor that the central bank has to keep in mind is the exchange rate. As we talked about earlier, even in the last 2 months, they've had to use about $25 billion of forex reserves. So we have seen post-US election, the dollar continuing to strengthen. US yields have moved up since September. Of course, more recently, the US 10-year has come down by from about 4.4% to 4.2%.
Yeah.
But really, the narrative is for higher for longer rates, right?
I take
And
your point.
that reduces the degrees of.
Ashish, I'm sorry I'm cutting you because I have to squeeze another question in and I'm running out of time. I take your point.
Yeah.
The forex, the external sector is very important. It doesn't give elbow room to cut. Devang, very quickly, do you think that there could be more liquidity inflows now? See, already yesterday and today, we have seen the foreign mood change. After days of outflows, weeks of outflows, it's changed. And it's quite possible now that that narrative has played out. We could see a Santa rally, we could see a coming back of inflows. Have you accounted for that? If there is inflows, then liquidity problem is solved.
Yeah, so actually in our calculations, we have actually taken in around 50,000 crores of inflows.
You took only bond inflows.
And with that also probably we need at least 1 trillion of liquidity infusion. So our assessment is, yes, personally, I also believe that probably the dollar rally and everything is largely overdone for the near term. So somewhere down the line, we should get some inflows. You pointed out FI inflows in equity. In fact, FI inflows have also come in debt in the last 2 days.
Yeah.
So
very quickly, Ashish, I agree. Sorry, I'm pushing you all. Very sorry. Ashish, last word on banks. Do you think now banks become attractive as liquidity comes in?
Oh, I think a bank in terms of valuations are already attractive. I think, but what is really needed is elbow room for banks and NBFCs to grow loans faster. And I think there are challenges both from liquidity and regulatory pressures that loan growth has been tempered down. And I think easing in both of these is really needed more than rate cuts, because even at these rates about a year ago, you had loan growth in the system at 16%, right? And so it's not that rates are really holding back credit growth. So I think it is liquidity, it is kind of regulatory action that is holding back credit growth, and I think that needs to ease.
Okay, I'm not very sure if the Reserve Bank was wrong in those regulatory rules because we have seen a growth in MFI and unsecured defaults, but that discussion for another day. Completely out of time. Thank you very much, Ashish and Devang, for putting new light on how we should look at the Reserve Bank policy. Markets gung-ho, believing that the banks are going to get more liquidity. Bank Nifty is leading. Wrap up on Bazaar. Chartbusters correct.